In the dynamic world of stock investing, understanding the forces shaping a stock's price movement is crucial. Investors constantly seek to decode the myriad factors influencing their investments. Amidst the myriad factors, one stands out: beta. This metric is a cornerstone in the realm of financial analysis. Beta acts as the pulse of a stock, offering valuable insights into its volatility relative to the overall market. It essentially measures a stock's sensitivity to market movements. Imagine the stock market as a vast ocean, with individual stocks riding its waves. Each stock navigates these waters differently. Some stocks glide smoothly, mirroring the market's movements. These stocks have a beta close to 1, indicating they move in tandem with the market. Others are like speedboats, amplifying every rise and fall. These stocks have a higher beta, reflecting greater volatility and potential for higher returns or losses. Beta helps us decipher this relationship, providing a clearer picture of a stock's behavior in different market conditions. Understanding beta empowers investors to assess a stock's potential for risk and return. It is a vital tool for portfolio management and risk assessment. This knowledge is fundamental for making informed investment decisions aligned with their financial goals. By leveraging beta, investors can better navigate the complexities of the stock market. Beta is calculated by analyzing a stock's historical price movements in relation to a benchmark index, typically the S&P 500. This involves a detailed statistical analysis of the stock's past performance compared to the overall market. A beta of 1 indicates that the stock's price tends to move in sync with the market. This means that if the market goes up by 1%, the stock is also likely to increase by 1%, and vice versa. A beta greater than 1 suggests higher volatility. Stocks with a beta above 1 are considered more volatile because their price movements are more pronounced compared to the market. For example, a beta of 1.5 implies that the stock's price is likely to move 1.5% for every 1% change in the market. This means the stock is 50% more volatile than the market. This heightened volatility can amplify both gains and losses. Investors in such stocks should be prepared for larger swings in their investment value. Conversely, a beta less than 1 indicates lower volatility. These stocks are less reactive to market movements and tend to have more stable price changes. A beta of 0.5 suggests that the stock's price is less sensitive to market fluctuations. It moves only half as much as the market does. This can provide a smoother ride during turbulent times. Investors looking for stability often prefer stocks with a lower beta to minimize risk during market volatility. Beta is a potent tool for investors seeking to build diversified portfolios aligned with their risk tolerance. Risk-averse investors may prefer stocks with beta values below 1, offering a smoother investment journey. Those seeking higher potential returns might gravitate towards stocks with beta values above 1. These stocks offer the possibility of outsized gains, but also carry higher risk. However, beta should not be the sole factor driving investment decisions. Investors must consider other crucial aspects, such as a company's financial health, growth prospects, and industry dynamics. Real-world examples of beta across industries. Let's delve into real-world examples to illustrate beta's significance across different sectors. Technology companies, known for their rapid growth and innovation, often exhibit beta values above 1. This indicates that their stock prices are more volatile compared to the overall market. For instance, Tesla, a pioneer in electric vehicles, has a beta above 1, reflecting its volatile nature. This high beta value suggests that Tesla's stock price can experience significant fluctuations, both upwards and downwards. On the other hand, utility companies, providing essential services like electricity and gas, tend to have beta values below 1. This lower beta value indicates that their stock prices are less volatile and more stable. These companies operate in stable industries with consistent demand, resulting in lower price fluctuations. Their steady performance makes them a safer investment during market turbulence. By analyzing beta values alongside other factors, investors can gain valuable insights into a stock's potential behavior. This comprehensive analysis helps them make informed decisions tailored to their investment objectives, balancing risk and reward effectively. Embrace beta and elevate your investment strategy. In conclusion, beta is a powerful tool for investors seeking to navigate the complexities of the stock market. It provides a quantitative measure of a stock's volatility, relative to the market, aiding in risk assessment and portfolio construction. By understanding beta and incorporating it into their investment strategies, investors can make more informed decisions aligned with their financial goals. Embrace beta, elevate your understanding of stock market dynamics, and unlock new levels of investment success. Remember, knowledge is power, and in the ever-evolving world of finance, continuous learning is the key to staying ahead.